Okay, what is going on, guys? Welcome to Stock Talk with Nico Criticos. Today, we're going to be doing some stock analysis on Constellation Energy stock. This is ticker CEG, and this is a company that has evolved from a traditional utility company into what many analysts are now calling a synthetic AI stock. It is currently the largest producer of carbon-free energy in the United States and is positioned as the primary solution to the AI power bottleneck. The business model operates as the largest nuclear fleet in America with 21 reactors, providing something that solar and wind energy cannot, which is firm, carbon-free, 24/7 baseload power. Then we have the data center connection with big tech. These companies have a massive problem, and that's that they need gigawatts of power for AI data centers, but have committed to net zero goals, which is going to be quite the problem or quite the, it's going to be tough to find a solution for that. CEG is the only company that can hand them a behind the meter contract where a data center is built directly next to a nuclear plant, bypassing the clogged public power grid. Then we have the Crane or the 3 Mile Island restart, which is a major part of the current narrative. And that's to restart the Crane Clean Energy Center, formerly known as the 3 Mile Island Unit 1. While there have been recent headlines about regulatory delays pushing the restart past 2027, this still remains a massive long term asset. Unlike regulated utilities that have capped profits, Constellation Energy sells a large portion of its power on the open market or through private contracts, allowing them to capture green premiums from desperate tech giants. That's great. Then we get into the stock, which we can take a look at the stock price here. Basically, the past 5 years, it's been a phenomenal performance for anybody who's invested in this. It's up over 500% just in the last 4 years. This year, it's done okay. It's pretty much been flat for the last 10 or 11 months here. So you kind of gotta. There hasn't been a ton of hype with the stock just yet, but in past years it has performed pretty good. So if we look at the market cap, we're sitting at about $103 billion company. Keep in mind, let's take a look at revenue. They did 25 billion in revenue, but their free cash flow is close to break even, and the net income has been going down for the last couple of years, but is still at about only $2.3 billion for the past year, and this market cap is over 103 billion now. So not super cheap. We're looking at about 39 times earnings. We have 16 analysts with a price target of about $386, which is a good amount, higher than where we're sitting right now. Management is targeting 20% plus growth for the next 3 years. And despite the high PE, many valuation models suggest a fair value closer to $400. The argument is that the market has not fully priced in the premium value of their annual nuclear generation. The sentiment around the stock is currently a battle between long-term structural demand and short-term execution risk, which we see that with a lot of companies right now that are, trying to capture business with the AI trend, and like Oracle's a good example of that. But personally, I'm bullish on that on the companies that are investing into it, even if it means it's a lot of capex and it looks kind of risky. I'm still, I haven't bought this stock yet, but there's others that I am bullish on, and so I don't think that's necessarily a bad thing. Then we have data center demand is projected to double in the next 4 years, and in the PGM region, where CEG is strongest, peak demand is forecast to grow by 35 gigawatts in the next 5 years. That's crazy. They are the only player with the available land and water to support this. That's a huge moat, right? How do you even really get a bigger moat than that? I mean, it would probably take a lot for another company to come in and match them on that. The bear case is that the nuclear renaissance is expensive and slow, which this is also true. But that doesn't mean you shouldn't invest. Recent delays in transmission upgrades and regulatory hurdles for co-location data centers sitting next to plants have caused some investors to take profits. There's also the execution risk regarding the 5-year restart of dormant reactors. So there is definitely two sides to this. Let's go down here now. There is definitely two sides to this, but still, I think I'm probably an advocate for investing into these data centers. The next 5 years for CEG looks less like a sleepy utility and more like a high growth tech platform. Here is pretty much the forecasted EPS or the analyst estimates. And we're looking at this year, $12 EPS, first full year of Calpine revenue. Then we have 2027. We're looking at 14% growth. So, you can see the growth rates definitely fluctuate, anywhere from 8% to 30% over the next couple of years. But I mean, if they actually do these numbers, I mean, Yahoo Finance has pretty similar ones going from 7 to 11 to 13. And then if they get to a point where they're doing whatever, 18, let's say anywhere between 18 to $20 in 3 or 4 years from now, well, okay, so let's do this. Let's say they're doing, I don't know, even if they get to somewhere around, let's say $18 in a couple years from now, right? Because that's realistic. $18 EPS. Then we come down here, we'll look at the valuation metrics and price to earnings. Again, they haven't been, it's kind of been going down, but right now it's at 30 because their net income has been going down. So that's why this PE looks high, 38 times. Really, the PE probably should be sitting closer to like 25. So if we take 25 times $18 EPS, that puts us at a $450 share price. That's a huge jump, right? And that's not 25 times earnings is not that much. I mean, maybe 20 times as like a more, if you want to be more conservative, a more bearish case, 20 times $18 EPS is still 360 bucks. So that still would be a smart investment over the next 3 years. If they do those numbers, if we're looking more short term, we're looking at $11 and then $13. They have them doing what? 11, 13, and then 17. That's where the big jump comes in because they're saying nuclear PTC roll-offs and higher market power prices. Yeah, that could change though. Scaling of 24/7 carbon-free energy matching. So maturity. Okay, so let's say it looks like they're going to have a big jump this year, first full year of Calpine revenue, right? So even if we want to be more conservative, let's say they only do 14 or $15. Let's say they do $15 EPS in a couple years from now, 2 to 3 years, and we put that at 23 times earnings. That's a $350 stock. So technically, the stock is kind of undervalued at this price. So maybe I will buy this. I don't know. I feel like I need to do some more research, but what draws me in the most? See, this is where it doesn't look good though. Why is revenue only growing 5%? I mean, earnings is more important, but still 5% revenue growth. What pulls me in the most is I'm always looking for a moat. What is the moat? Because that's what truly gives you an advantage and keeps you alive, and able to compete and, not have people steal your market share, basically steal your business. So if things like having the amount of land and the amount of water and all this stuff, and they have access to these things that other companies don't, that's what would make me bullish on a company like this. So I will probably spend more time investing and researching that. But if they have a strong moat in regards to the land and all that stuff and the contracts they can sign, then I could see me potentially buying this. But that is my analysis for Constellation Energy. Let me know what you guys think, and I will see you in the next video.